The moving average convergence/divergence indicator is a momentum oscillator primarily used to trade trends. Although it is an oscillator, it is not typically used to identify overbought or oversold conditions. It appears on the chart as two lines which oscillate without boundaries. The crossover of the two lines give trading signals similar to a two-moving average system. How this indicator works. MACD crossing above zero is considered bullish, while crossing below zero is bearish. Secondly, when MACD turns up from below zero, it is considered bullish. When it turns down from above zero, it is considered bearish. When the MACD line crosses from below to above the signal line, the indicator is considered bullish. The further below the zero line, the stronger the signal. When the MACD line crosses from above to below the signal line, the indicator is considered bearish. The further above the zero line, the stronger the signal. During trading ranges, the MACD will whipsaw, with the fast line crossing back and forth across the signal line. Users of the MACD generally avoid trading in this situation or close positions to reduce volatility within the portfolio. Divergence between the MACD and the price action is a stronger signal when it confirms the crossover signals. An approximated MACD can be calculated by subtracting the value of a 26-period exponential moving average, EMA, from a 12-period EMA. The shorter EMA is constantly converging toward, and diverging away, from, the longer EMA. This causes MACD to oscillate around the zero level. A signal line is created with a 9-period EMA of the MACD line. Note, the sample calculation above is the default. You can adjust the parameters based upon your own criteria. Two great MACD trading signals. The MACD indicator is basically a refinement of the two moving averages system and measures the distance between the two moving average lines. MACD is an acronym for Moving Average Convergence Divergence and was introduced by Gerald Oppel in his book, The Moving Average Convergence Divergence Trading Method. Basic MACD signals. The MACD indicator is primarily used to trade trends and should not be used in a ranging market. Regular signals are taken when MACD crosses its signal line, normally calculated as a 9-day exponential moving average of MACD. Trending market. First check whether price is trending. If the MACD indicator is flat or stays close to the zero line, the market is ranging and signals are unreliable. Go long. When MACD crosses its signal line from below, go short. When MACD crosses its signal line from above. Two great MACD signals. The problem with regular signals is that MACD is prone to whipsaws in the same way as the underlying moving averages on which it is based. Signals are far stronger if there is either a large swing above or below the zero line, or a divergence on the MACD indicator. MACD indicator. We, the Homo sapiens, want to live within our comfort zone. We love to change but hate being changed. I can hear an echo. Thanks for converging your thought with that of mine. It has to be. After all, you and I are traders. Hence, keeping our thought equality. I would write this blog on a very simple and easy to use tool: moving average convergence divergence. Yes, it's one of our most used indicators, right? Note, MACD is also known as MACD in colloquial terms of traders. Being a chartist, you must be knowing that each price reflects the consensus of value among the mass of market participants at the moment of the trade. What is moving average convergence divergence MACD indicator? A moving average is nothing but a representation of an average consensus of value in a selected period, rather, a composite photo of mass consensus. It identifies trends by filtering out daily price ripples. Excessive variation makes it difficult for traders to get clarity on a security's overall trend. The price movement is smoothed out by the help of moving average. Once the daily fluctuations are removed, we can identify the true trend and increase our probability to win a trade. The average can be anything. The time frame depends fully on traders. You are free to choose any. There is a variety of moving averages which differ in the calculation, but their interpretation remains the same. The calculations only differ in regards to the weighting that you place on the price data, shifting from equal weighting of each price point to more weight being placed on recent data. The most common types of moving average are simple, linear and exponential. A beautiful oscillator can be made by comparing the difference between two moving averages. The use of two moving averages in the double crossover method, therefore, takes on greater significance and becomes an even more useful technique. All credit goes to Gerald Oppel, an analyst and money manager in New York, for creating this trading indicator in the late 1970s. It is one of the simplest weapons that traders